market is comfortably above the 22,700 mark, and it's the leadership of the large cap which actually come in. Let's take the discussion on markets forward with Harendra Kumar, who's joining us from Elara Capital. Harendra, good afternoon. Thank you so much for your time. First of all, I'd like to understand from you last few days. You are someone who, likes to connect dots across factors. And however much we may debate that whether election is a long-term factor, it may not be, but short-term it is definitely a factor. And some sections of the market were getting nervous as we go into elections, saying that, what could be, which way could it swing? I want to understand from you from the practical standpoint, leadership, continuation in leadership is what the street was expecting. In whatever fashion it may come, do you think street will take it or absorb it, or a weak win by the current leadership may actually impact sentiment in the short term?
Yeah, good afternoon, Ajay. I think it's a very pertinent question. And, we are always amazed at how jittery the market becomes before every election. The most asset managers would say that elections don't matter. But now we are seeing a renewed interest in terms of trying to figure out exactly where the numbers are going to pan out and how they're going to pan out. Now, why this election is very important is, I would like to point out to the growth trajectory of the nation. I think the most consensus number is around close to 6.5% trend growth for India. But if India has to grow to a developed economy, to a developed country, we have to grow at 8% if our 2047 objectives have to be achieved. Now, this differential spread of 200 basis points cannot be achieved with the current political construct of the country. So a lot of the state subjects, such as power, education, judiciary, etc., will have to somehow be adjusted from the concurrent list or state list to the central list if India's GDP has to grow. And that can only happen with constitutional reforms. And hence, the 370 number becomes very, very material for the market at large. So yes, the numbers with simple majority, the country can go on. But if it needs to lift its growth trajectory, we need to have 370 plus. So I think this is the context of this election. Whether the incumbent government gets there will tell us whether the country will see a re-rating of its terminal value. So if we get that number, the markets definitely should gap up, or the trend should continue up to December. If not, you could go into a sideways movement. So yes, now the markets and investors are evaluating whether numbers and how they're going to pan out. And hence you see some amount of nervousness in the market at the given moment.
Harinder, let's shift focus and talk about more durable factors on which the direction of the market actually depends upon, like earnings quality and valuations. The tally so far has been pretty mixed, I would say. There are some mid-tier companies like Poonawalla, for example, or Jana, for example, or a few others with blowout set of numbers. At the same time, there have been some which have been mixed and soft. How have you analyzed the numbers so far, and does it support the valuation trajectory?
Absolutely. I don't think there is a material headline risk to the Nifty at these prices. So even if on a forward basis we are trading at 21 times, the earnings growth is going to catch up. Many of the companies are trading at attractive valuation. Some of the PSU names, the power names. I don't think there is a valuation risk on the headline level. Mid and small cap, yes, there could be pockets of overvaluation, but that get digested over a period of time. It comes with this relevant risk. So we are not worried on the headline Nifty. We have a view that, you could see a possible 15 to 20% return up to December. We are on the optimistic side of the, of the market to the extent. So where is this return going to come from? I think the big outlier return is going to come from the auto index. Now, we have seen that the sector is coming out of its COVID lows, and in fact, it's just broken out of the COVID highs that it had posted. So it's one of the lagging sectors that actually has caught up. So I think FIIs love this space. Numbers are backing it. And the trend growth is going to be superior to other sectors. So yes, auto numbers were very, very good. So it will continue outperforming some of the other sectors within the index. The other more important thing is, I think the bank Nifty, the numbers posted by ICICI Bank are quite impressive. And we are going to see a significant amount of re-rating as the FI flows come in within ICICI Bank as well. So the bank Nifty, which is kind of in a reasonable valuation zone with private banks not having done so much over the last 1.5 years, could see some amount of re-rating, which is this is a very nifty, heavy sector. Tech per se, I think it's been very tepid. So it's going to struggle in terms of outperformance. But your outperformance will come from autos, banks, and metals, and this should be sufficient for the Nifty to move and be on course towards this direction return for the year.
Also, somebody who likes to see bigger trends. Now, one point I want to get your opinion on. We've been trying to probe right from Mr. Modi when he came down to our program in ETGBS and hinted that he's been working on the next generation reforms. Ever since all the other team members from the minister's side, what do you think next generation reforms from the government could entail? Could it be more of the same continuity, or there could be some areas which have not been touched now but could be area in focus?
It's a very important question. I think you're seeing big change in the way businesses are delivering. Actually, it's because a classic "who moved my cheese" movement has happened to some of the incumbent companies that have been operating, who have been leading the sector for a long period of time. It's happening in paints, it's happening in FMCG, it's happening in the financial sector with the entry of fintech. So there is an element of disruption which is already underway. So if you're going to forecast the GDP trajectory over the next 5 to 10 years, it's going to come from sectors that are traditionally never existed in India. For example, we've seen EMS players doing really well. You're going to have a huge semiconductor ecosystem that's going to come. You're going to see listing of EV players. You've already seen IPOs of companies that were digitally seeded over the last 10 years. So the new incremental gross value added of the economy is going to come from sectors that we don't understand, we've not seen, or we don't understand well. And that's something that people will have to grapple with. The other big trend is, I think we are getting ready to be an export economy. I don't think this is understood really well, given the logistics layout that's happening across the country, the government's focus on the dedicated freight corridors, the warehousing stories, and the India-Middle East economic corridor. I think the big picture is India will have a manufacturing setup that is looking to export to Europe and more. And this is going to be transformational because India is never seen as a manufacturing hub and more as a services hub.
What are the other big themes you're recommending to your clients and you're studying to make some big alpha or where you see the profit pool will expand materially next few years?
I think the difficulty for most people is coming in how to price in the capital goods stocks. We're seeing them as sector leaders of this new rally. And be it ABB, Siemens, Thermax, all the engineering goods services company, we are seeing a multi-decadal rally being played out here. We are on the cusp of a manufacturing boom. The more and more companies we meet, everybody's waiting post June 4th to lay out their capital expenditure plan. So this trend is going to become very, very strong. It's after a decade that capital goods are beginning to outperform the Nifty. So the recent run-up, of course, will perplex a lot of value investors, but it is taking the shape of a dragon, it is going to lead the rally. So yes, capital goods will be an outlier performer or a sector leader which needs to be watched out.
Right. Last 3-4 years, also what has happened is that a lot of smart managements, disruptors, and kind of managements who are agile to find opportunity in areas, even if they were small in size, actually took up a lot of market share. And you spoke about this from a larger companies and incumbents. Do you see this category of mid-cap, small-cap, which may be small in size but not small, they may be the dadas of their own space, continue to make big money going forward? Should we look at mid-cap, smaller differently, or it's okay to put them in the same basket?
Oh, not at all. I think, as the economy broadens, in a recession period, you see the convergence of money into the leaders. But as the economy starts to do well, the value creation process broadens. So I think the mid cap, more than the small caps, has a longer runway, in a bull market. And historically, also we've seen that mid caps tend to outperform large caps, which is true because the earnings grow at a faster rate, given that they're capturing market share, getting into newer markets, etc. So yes, a large part of your allocation should be mid caps. And I think what technology and capital is giving is the ability for the companies to morph much more faster. So the companies who are smaller are more agile and more faster in taking market share. So I think it will be a mistake to miss out saying that they are on the mid size and they will not be able to win against the larger ones. I think you need to be staying focused on mid caps. Some of the tech names as well, we've seen that now they become debt free. They've raised capital. They've undergone transformation over the last 2 years post listing. I think they'll also come back into the game. So it's the approach to broaden your target investment segment is actually very, very critical for any investor.
What about global? Before I let you go, Harendra, just a quick view on the global developments. Yields are elevated back again. Dollar index is also again rallying, and the data coming out of US is very mixed. On the one hand, US Q2 GDP came out so strong that everybody thought that rate cuts will get delayed. Then the next set of quarterly GDP from US came in weak, but US retail sales is strong, all of that. So the messaging from US data has been very mixed. What are your thoughts?
Yeah, so how do you play a macro framework? I think ideally sitting out of India, what cues do we take globally? So the cues we take globally is this, at least now we have the framework that there is no rate cuts for the rest of the year. Europe is going to struggle. Energy prices might stay elevated because of the Middle Eastern and the Ukrainian conflict. So interest rate in India will stay higher. Inflation will be higher. Now, in that context, we can build a strategy on investing. So our view is that if this is going to remain, none of the current themes are going to undergo a change in India. But mind you, the longer the interest rate scenario remains like this, the Western economies are going to struggle. And that would mean that China would also struggle exporting to them, and India becomes an interesting destination. So in this context of safety plus growth and an average inflation trend for India, we're expecting FI flows to be higher than last year and more FDI flows as well. So I think our rupee is going to be okay, which means more flows and a more supportive equity market for us.
Excellent, Harendra. Thanks so much for your time.
If you like this video, then like, share and subscribe to ET Now.